now would be a good time while we wait on gold. Can you talk a little bit more about the dollar cost averaging and strategy, please? That sounds interesting. Yes. If you're in USD, JPY, which I know we have not been trading on a JPYs, for example, this is our high. Depending on your strategy and your account balance and your lot sizes, you're not going to do your full like 5% risk if you were trying to sell here, for example. You would do a very, very, very small amount, think 0.1%, 0.05%, very, very small. And the purpose of going so small is because you're looking for large baskets of trade if you're wrong. There's smaller ways to do this. There's larger ways to do this. I know a guy who had multiple 7 and 8 figure accounts who does, dollar cost averaging in batches of 3. So for example, if he takes a trade here, he's allowed 2 more entries. Stop loss remains the same. It's very far away. He can take this trade as a sell. If it goes against him by X amount of pips, he's going, or points or ticks, whatever platform you're on, he's going to take another entry. Typically, they're a larger size the farther away you go. You can also do the same lot size over and over again. There's a case to say, hey, it's much easier to recover if this one up here, let's get my annotate, hold on. If I sold here at 1 standard lot size, and I sold again at 1 standard lot size, and I sold again at 1 standard lot size, that's going to take a lot longer to recover those 3 entries than it would be if I took a 1, a 1.25, and a 1.5, right? If each one of these are bigger, then my recovery, I only need to get to about here or here to recover if I increase my lot size on that dollar cost averaging in. If not, if I took the same lot size over and over again, I need to get to about here before I'm totally break even plus profit plus swaps and spreads and everything else that goes into it. The dollar cost averaging just allows you to be wrong more often. It allows you to take more trades if you're statistically accurate enough, meaning fine, your trade analysis is good, but maybe it's going to pop up a level or two. It's a really great idea to help you be profitable long term, to help you potentially say, hey, look, I don't have to take a loss. I can take another entry, take another entry, take another entry. But of course, let's talk about the ugly side of that. The ugly side of that is what? Let's close my annotate for a second. Please close. The ugly side of that is it doesn't have to turn around. There's no such thing as super overbought or oversold. The market can sell forever to zero and beyond. The market can buy forever. Just look at NVIDIA, right? There's no sense in this has to turn around. That's where we get into trouble. Same thing that we're seeing right now with gold. We go to gold. This is a huge move on the smaller time frame. If you're trying to dollar cost average into this, you might find it's hard to get out. It might be very hard to get out. If you took this entry down here for whatever reason you're trying to sell back down, you can only dollar cost average so many times with the same lot size. Because now you need your recovery to be like 80%, 70%, 60%, depending on how big the move is. Because you've got to cover your swaps, your negative or positive swaps, all the stuff that goes into that, your commissions, the fees that go into trading. But there's a negative side to it too. You have to know when to cut the cord, how many entries you're going to take, et cetera, et cetera. I'm a super big advocate of increasing the lot size. It just doesn't mirror well. If you increase the lot size even minimally, so think a standard lot and then a 1.1. So that's a 11% increase. 11% increase still means you don't have to have as big of a retracement to recover.
If price is moving up and you're selling into that price, just remember that all of that stuff is going to be continuing to pull against you. You'll be going deeper and deeper into drawdown until you start to recover. But you just need to plan your size if that's the way you want to trade. So you need to trade small enough that even with increasing lot sizes, you still have plenty of room before your maximum risk.
That. I think the reason why it failed for most people is because they try to do dollar cost averaging with their traditional lot sizes, which is just a recipe for a disaster. That's not going to work. If you want a dollar cost average, you need to cut whatever risk you're using down by 95%, and then it will 95% of the time work for you. Sometimes the market's going to go crazy. You've got flash crashes and stuff, but other than that, the principles and the mathematical theories, they work, period. With the exception of the most extreme circumstances, if you're not over risking, you should be able to recover, with the exception of the huge things. But now if you're trying to do, hey, I'm doing 1% and dollar cost average, well, 1% is not that much. It is if you have 10 entries and you have margin and you have 100 to 1 leverage and you have swaps and fees and commission, 1% is exponentially too much. Because every time it goes in a drawdown, that might have been 1% of what you think is your risk, but it doesn't work that way because there's no stop loss typically when you're using most of the like EA versions don't have any version of a stop loss. They do stuff like that. But you can do something comparable manually. You can say there's a few top step traders who do something like that manually, who take their entry. If they're wrong, they'll take one, and they do have a stop loss. If they're wrong, they'll take one additional entry and scale in, right? But their stop loss remains the same to their set predefined risk. And now, here, let's get my annotate back out. The cool thing on Top Step or like some of those feature platforms is cool and bad. If your original entry is here and then you take a re-entry here, it makes it look like your actual entry was here when it wasn't. It was here and here, but it moves your entry.
Yeah, that depends on the weighting of each of your entries. Where Johnny put the, where it shows is assuming that the top one up here is bigger than the one that was down here in order to get it up to that. Because
Yes.
it's going to be the average of those two entries. So it'd be volume times price plus volume times price divided by 2. You are going to add up the volumes times price of each of these entries. And then once you add that up, then you divide by 2 or however many entries there are in order to get your end result. That's what the broker is going to be doing. So you can weight it more toward the upper one by adding more size at the upper one.
Does that make sense, Brika? Very cool. Very, very cool.